Hey everybody, welcome back to Watch Trading Academy, and today we're going to break down the difference between watch trading and watch investing. Something that a lot of people don't realize is that terminology matters, and so when we say watch trading, we typically think, well, isn't that the same as watch investing? Now, you may have seen a video previously on this channel called Watch Trading Explained Step by Step. In that particular video, you will have been taken by Cal Knight through the basis of how to actually get through the process of buying a watch, trading a watch, and basically creating a profit. However, on the investing side, the world is a little bit different than the trading side. A trade involves a transaction. An investment involves something trading doesn't have, time, meaning that we spend more time holding a watch in an investment than we do in a trade. So when we talk about making money in the watch business, we typically look at the aspect of watch trading such as I buy this watch, I wear this watch instantly because I enjoy it, or I keep it in a box if it's brand new, unworn, and I trade this watch, I list it for sale, I find what values are and so on and so forth, and I bought it below that where I've created what I call a margin, right? And this requires me to post my watch for sale, create basically commerce as a result of a transaction. However, a lot of us don't necessarily have time to do that because it basically requires us first to learn the business, create the transactions, and then reap the rewards. And usually the rewards are good because, you know, the average watch margin, as we talked about, is about 20%. So 20% on $10,000, $2,000, that's not little money. That's very good money for a quick trade. Imagine if I told you within a text message I could make $2,000 to $10,000 off of just holding a watch in a vault and shipping a watch. That sounds pretty exciting. But what you don't see in that model is that the 10 years before that, where I've not only acquired a client base, I've acquired the ability to buy these watches cheaper, and so on and so forth. So watch trading is not only a great tool because at some point in the next 3, 4, even 2 years from now, as you're doing it, you're going to get so good at it that it's going to become more passive. But reality is that some people just don't have the exact time to sit there and add this. And also, there are some people that aren't that good at marketing, that aren't that good at selling, don't want to talk to others when it comes to like talking online, or scared to get scammed. I mean, listen, everybody's bound by their own limitations, so it's up to you to choose to overcome yourself or not. But trading is one style of making money in the watch game. There's also obviously wholesaling, which you've heard about, which comes from the idea of buying from a jeweler only to sell to another jeweler, or buy from a person to sell to a jeweler so that they can sell for a higher margin. So the entire goal of wholesaling is to not deal with, again, time holding a watch because of limited capital. So usually limited capital means people either broker watches or wholesale watches. Some capital means people usually trade watches because they're okay putting their own money on the line and therefore earning a bigger margin than a wholesaler who earns sometimes usually between 3 to 5%, which is way lower, right? And then there is something bigger, which is called investing past that. And what we're going to talk about today is the investing model. So I want to show you kind of the way things work here. So in a regular trading model, right, this is a depreciation for a watch, right? A watch in a normal market would go down like this, then would stabilize and would start to rise, right? The argument would be this would be the retail band, right? And this would be the wholesale band, and it would kind of follow through, right? The goal of a trade, and I'm going to label this trade, is to basically buy on the wholesale side here and buy this margin right here between the retail and wholesale side. And ultimately, at any point you go through, you will have a similar line here between the two, which means that, you know, if you buy here, let's say 1 year later versus if you buy here or here 2, 3 years later, the margin tends to stay the same based on the model. Now, in the investing model, which I want to show you something completely different, we look at things a little bit different because we're looking at often watches, let's say to start here in value, that typically either stay flat and then start to rise in price above MSRP. These are your investment model, which typically is your Paddock, not all Paddock, right? But your Paddock AP, rare Rolex, etc., it goes for more than MSRP immediately, right? And here's the other interesting piece is that, it's going for more, and it's not always, the other part that's important to understand, that line doesn't always keep going like that. Some other watches start like this, go up like this, go up like this, go up like this. So in various reasons, like they have these pauses in between where basically they're not moving too much, but they have these upsides as well. So you have your up here, your hold here, and then your up here, your hold here. We can use an example of this looking at the John Mayer dials, the ones that were basically the Rolex, the yellow, gold, green dials, starting here right about 40K with tax, and you have your thing here. And then, you have a hold period where it's not doing much, they're still new, etc. Then they rise right here to the 60K line, but then they kind of hold because they went up, to 80, 90, then they came back to 60, and they held that 60 to 70K. And here at 70K, it jumped again, and the next jump was 90K, and then again you had a hold, and the next jump here was 110K, and here we are now trending up. The point I'm trying to make is that at each stage of the game, there's a rise going on, and this pattern right here that you're seeing is basically a 4-year pattern. This is 2018, and we're using this as a real-life example if you want to look it up. So it's 2018 to 2022, which gives us a 4-year pattern where the watch went from basically 40,000 to 110,000. So that gives you roughly a return of what, like 250, no, almost 300%, we're going to say, because 80, 120, so 250% return, right? That means if you put out 40, you got out 110. Now, in the investing model, it's a little bit different than the trading model, and the reason that is because first off, investment watches have significantly more demand and more players in the game, which is very, very important to understand. So more players means more liquidity, meaning more ability for you to buy and less need to try to sell, meaning you don't have to try to sell someone on wanting the latest blue dial brick. You just have to have the watch because it's, one, incredibly hard to get. Secondly, also, not only is it hard to acquire, but there's going to be a multitude of people willing to trade this watch on the basis that their clients will probably want it, and they also can't get it. So what happens, though, is that there is a price play to some extent, but supply is always incredibly limited in the best investment watches. And that means there's more likeliness that the person buying from you here at the 250% mark is not an end user, is not someone who wants to enjoy the watch, but rather someone else who believes in this trajectory up. So at each stage of the game, basically 60, 70, 90, you have new players that want to take advantage of the next loop. And one of the things that happens is at the beginning, once you are kind of novice at this game, you buy here, you hold 4 years, and you sell when you believe you've gotten a return that you're happy with. When you're an expert at this game, you basically buy here and sell here, and then buy again here and sell here. So you're not holding that time where you're wasting and keeping the capital for 6 months in a watch when there's a hold pattern, right? It's almost like saying you buy stocks, you get out, you buy other stocks, you let those go up, then you come back. But the point is to basically ride these little upswings, with everything. Like the upswings are where you go. Now, someone's going to wonder right in the comments, well, how about you tell us how you find out these upswings? Well, this is part of what we teach here at Watch Trading Academy, and that's why we have a free training for you right in the description. So you don't have to ask me that. You can take the training, join the community, and learn how to become a watch investor and trader and wholesaler all in one place, so you can actually execute on trade charts like these and win, and ultimately make these kind of returns like many jewelers. Because as I always say, I've never met a poor jeweler, and I'm sure neither have you. Especially if you're good at this, you'll start to realize that that world is incredibly filled with money, and that's because they're trading money, right? It makes sense. So one of the things that, again, I want to point out here is this is a John Mayer dial pattern kind of up, and this is why watch investing is really interesting if you're limited on time, meaning if you have less than you don't have that hour a day that you want to devote to watch trading and looking for deals. You don't have this desire to build a business and do a lot of transactions. You feel uncomfortable talking to people on a continuous basis, meaning like you don't want to attract people on the internet, talk to them. you feel you're afraid of your security. What if they know you have a watch, or blah, 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 blah. Whatever your reasons for being afraid of undertaking watch trading, watch investing basically gives you the ability to buy a watch like a normal human being that would wear it and allow it to turn into a 250% return without doing anything, just by wearing your watch and just making sure you don't lose it. And then 4 years later, just sell it. We've seen very similar patterns to this, very, very similar patterns to this with the with Patek watches as well, right? This is more of a Patek thing going on when it comes to, for example, the 5980, which you've seen me wear as well. Let's say it started right here at 100, went up, plateaued, went up, plateaued, went up. And at each stage, we'll say 100 here for the sake of argument. Then we had the next batch at 150. Then we had the next batch here where it was about to go up at 160. Then it went up to 220, and then it finally now is like 330. So this is a very exciting, 300% return, like probably 330% return, but it'll give you an idea. Again, don't quote me on the math here. I'm just kind of giving you generics. But the point here is, again, you see that, and again, we're seeing that in a 4-year ratio. Now, here comes the next argument. Well, we know that the inflation kicked in, and all of this inflation, it has nothing to do with inflation. Remember that watches, and one of the reasons why investing in watches works particularly well and is incredibly safe, is that watches are, and I'm going to leave you with this because you have to have some kind of reason why you really want to learn how to do this, but watches are what I call a global currency, and we're going to kind of understand that. So what that means is that, let's say your watch, for example, is, I'm going to use this very basic, there's no watch for $100, but let's say you have a $100 watch that you're buying, right? Now, let's say this $100, right, is worth, for example, I don't know how many, like pounds, maybe like 70 pounds. So 70, I think less actually, okay, 60 pounds. So we'll say 60 pounds in the UK is basically worth $100, right? So when you look at that, the advantage here, okay, is that the UK's currency is stronger than the US currency, because $100 buys 60 pounds. So therefore, when you go to the UK, your money is devalued, right? So basically, you're losing money, correct? Like, everything makes sense here. So this is why global currency is so vital to the watch market stabilization that people don't understand. When I say watches are a good hedge against inflation, they're a good hedge against recessions, it's because they're tied not to one country's money, but rather the global currency and the idea of money. So, for example, if in the UK right now this is the spread, then your money will buy more in America. So people will come here, right? Will come here and say, hey, I'm going to use my 60 pounds to buy a $100 watch, so I'm in a better position, right? And then basically what happens is, because you can buy more, this market comes into the US buying our supply. What occurs, though, in the watch market is it's a globalized currency. So let's say the watch, for example, was $100, and this came here, right, to purchase these watches. Well, what jewelers do is, because it's a global item, they'll look at it and go, okay, so if this was a one-to-one, because it's a watch, not the currency, what would 100 pounds be? Oh, it'd be 140. Okay, so we will raise the price of the watch to market value of 140. You just now basically stabilized the currency and no longer make it worthwhile for this person here to come into your country to buy the watch. Because what occurs now is that for them to come here, they're no longer buying a better deal. They're buying the same deal as they would get, because before they were at 60 to 100, right? So that basically meant that their money, right, was going to buy them more. But now, even though the currency hasn't changed, the watch pricing has elevated itself to ensure that this transaction does no longer occur. And instead, this transaction takes its place. And so what ends up happening is the stability of currency is what enables the watch market to increase for watch investors. And this is important to say for investors, because one of the things I want to make you understand is that, remember, we're looking at trajectory like this. And a lot of these ups at different stages come from globalized events. So this may be linked to shortage in China for Rolex. And this next wave here is linked to Europe. So the point that I'm trying to make is that at every stage that the watches move, it isn't necessarily based on something happening in your environment. But let's assume, for example, that we as the United States go through a recession or something where the values of goods typically drop. Now, since there's a currency stabilization market, while we're going through a recession, China or Europe won't be going through the same recession at the same time. So watches will become very exciting here, and therefore money from China or Europe will move in to buy our supply. But since they will fly in, and this is a global currency, our pricing will continue to rise. So therefore, in a market where everything is collapsing, watches will continue to be strong because of global demand and because of the ease and liquidity of moving money. And this is important, this is very important to understand, because you have to realize that watch investing is about longer global outlook of certain watch brands and models that are going to be in high demand globally and that are going to be able to come back regardless of where to travel at a similar rate. So let's give one simple example. You have to basically buy watches when you're investing that are going to be easy to move. And what I mean by that is, let's assume this. Every jeweler across every single country will want to buy a Patek 5980 for inventory at the right price. They will not want to buy a Panerai, a Corum, or a Breitling. These are generic watches that don't make investments. Investment watches are watches that have high liquidity, like AP, rare models, Rolex, rare models, of course, Patek, most models, most Nautilus and Aquanaut models, and then in addition to that, a lot of the Richard Mille models that are hard to get worldwide. But even Richard Mille might be temporary. But for now, what we're looking at here is just the understanding that watch investing is for you if you're someone who has less time, does not want to be bothered with people online, and more importantly, can be analytic and can actually hold capital into a watch and make some money while enjoying a watch. And while most people would put $10,000 or let's say $20,000, $25,000 at 1% at the most in a savings account, here in 4 years with your 25%, you could earn anywhere from 100 to 150%. And the higher you go, the more expensive and nice the watches get. And the 100K margin, like where the 100K line is what gives you the 300% multiple usually on the right watches. So anyways, hope you've enjoyed this video. If you want more content like this, please like, subscribe, turn on notifications, and of course, please take the training in the description. We have put together a free training for you to help you understand how to get in the world of watches without losing money. If you've been paying attention to anything we've been talking about, a lot of people over the last 6 months have gotten in the watch game and put themselves in seriously bad watch positions as a result of just hearing a buzz on the internet that the watch market is on fire and they should want to play. Don't be that guy. Instead, learn the fundamentals and get in the right way so that you ensure you not only protect your money, but can also get out and make some serious money. This has been a very easy to understand description of how watch investing works, and hopefully it's for you enough to be curious enough to click the link, and I'll catch you on the next video for Watch Trading Academy.